Welcome back to the Reagan RedZone. I'm your host, Webb Milward. Joining me today are two of our partners, Harrison Brooks and Brian McNeely. Fellas, good morning. Welcome to the Red Zone.
Morning.
Morning, Webb.
Happy holidays to you guys and to all of our listeners around the world. It is a great time of year. It's a great time of year to be thankful for our business, be thankful for our clients. For Reagan, we are finishing our 30th year in business and just have a lot of excitement for the future and a lot of gratitude for all of our clients and friends in the industry. It's also a great time of year because AMC is now showing Christmas Vacation 24 hours a day. So anytime you want, you can log in and watch that excellent movie. But with that, let me set up the red zone for today, guys. We're going to do two things. One, we are going to do kind of a rapid fire recap of highlights from 2025, things that stood out to you all. And then we'll turn the page to 2026 and we'll throw down a couple of predictions and share some thoughts on how we think top firms will perform and should be focused next year. So with that, let's start with 2025. I'll tee up the first one that's on my mind this morning, and that is the notable slowdown in organic growth throughout 2025. Just to give you a quick stat, our growth and profitability survey, GPS, we've completed 3/4 of 2025. The median organic growth for Q1 was 7.9%, for Q2 was 7.8%, and for Q3 most recently, 7.4%. Just as a refresher, we ended 2024 on an aggregate at 9%. And prior to that, we were up in the 10s and 11s, coming out of COVID. Middle to high 7% organic growth median. Certainly there are firms that are still knocking it out of the park, but the median has dropped pretty significantly. So maybe just get a quick reaction from each of you, and then we'll dive into some other topics.
Well, Webb, the growth might have slowed, but your wardrobe has accelerated in performance. Okay. So if you're not tuned into this podcast and seeing the video, you might just want to open up the video just to see Webb's bow tie. I'll leave it at that.
'Tis the season.
I would even go so far as we'll loop the bow tie in with the Christmas Vacation, and it's a real Beaut there, Webb.
Yeah.
Well, I got to make sure not to talk too much with my arms because this clip-on might fall off mid-broadcast.
Oh, that's good.
Yeah, I'll start. I mean, organic growth, definitely the hot topic of the year, certainly having an impact on brokers and their organic performance, having an impact on the public brokers and how they're performing, and especially how the market is viewing the valuation of their stocks right now. What's interesting is I still hear a number of conversations from folks that I talk to around the country with the fact that it tends to be, or it seems to be, very geographically focused, with some feeling the impacts a lot more than others. I think folks with big exposures on the coastal areas are getting hit pretty hard right now. I mean, I've heard stories of Florida being down 25% on property rates. So I think it's definitely the story of the year. There's some other ancillary stories that popped up, but I think organic growth, or the soft market, had a big impact in 25, and I think we'll continue to see the impact in 26.
Yeah. And for 9 years, the tide has been coming in, and this year it started to go out, right? And the question is, how far does the tide go out? How much does organic growth slow? We are seeing, it's still technically a hard market. It's just a softening market. So, all three lines of business down this past quarter, whether it's commercial, personal lines, or employee benefits from an organic growth perspective. So something to watch. I would just say, like, how are brokers feeling? I don't think they're raising the alarm bells. I think many were anticipating this. I think it's just, the question is how fast and how much. So that's where we sit today. And that's what I think the big storyline in 26 is going to be, is to try to answer that.
Yeah, and I was thinking about this a little more recently, and I think probably should knock on wood, certainly for our folks with coastal exposures, but I think the hurricane season is officially over, and hurricanes have typically been a big driver of losses and therefore increasing rates. But I think that is officially over, so that should have a impact on rates softening even more potentially as we head into 26. Just something I thought about recently that hadn't really been discussed is no hurricanes this year of any substance.
Point. Harrison, let's throw it to you here. Let's do the same thing for M&A, kind of your reflections on the M&A environment in 2025. number of deals, who's doing the deals, what are the dynamics within some of those larger acquirers?
Yeah, so the recap on the M&A activity, I mean, the final numbers will get printed here at the end of December in terms of the number of deals. But to me, that's kind of noise in terms of the number of deals. I think we'll finish between, historical averages if we've looked back over time. So 500 to 600 transactions would be my prediction. A lot can close at the end of the year, so we'll see kind of where the numbers land. Um, but what we have seen this past year is a continued, the large deals that have been announced in our space, $40 billion of transaction value, largely driven by the public brokers buying private equity backed platforms that have been built and aggregated over time. And now that those institutional investors are looking for liquidity, I think we'll see, we could talk about, I think we'll see more of that. I think the sustained level of M&A activity, folks are also really dialing in the M&A machine in terms of tuck-in acquisitions. So, having business development teams on, to help generate M&A activity. So I think you see some rise in the number of transactions for certain players because they're building this infrastructure. So that's number one. I think number two is as new entrants get better at it, some pull back. There are firms that, maybe their growth wasn't as anticipated or valuations went up and they couldn't be price competitive. And so you've seen them lay off entire M&A teams and get out of the M&A game, probably harvesting the margin of their business to sell to a publicly traded broker. So some institutional backed players are getting out of the M&A game, where there's others that are coming in. Just recently, I was at InsurTech Connect in Las Vegas with 10,000 of my best friends out there, Webb. And the number of firms that I met that were classifying themselves as AI backed roll ups. So artificial intelligence backed roll ups to go out and aggregate and integrate what is still a very fragmented landscape. If you look at 92% of firms in our industry are like less than $1.25 million in revenue. Agents and brokers, 92% of the agents and brokers, the 35,000 or so that are out there, are less than 1.25 million in revenue. So a lot of folks are raising capital, hundreds of millions of dollars with the thesis of we'll go buy small firms, can do it quick, can do it efficiently, and can leverage technology and AI to integrate and operate these businesses. I think some will do it effectively, and I think some will not. And as we've seen in the past, running an insurance broker, there are some things that are simple about it, and there are some nuances as well that there's a reason, kind of barriers to entry. So I think as we look at the M&A marketplace, it's a good year, and I would expect that trend to continue as we think about 26.
Yeah, it sounds like the buyer mix
Yeah, I
is
would add
changing as
one
well.
thing to that, and that's just regarding the number of transactions that are being done. I think the data we're using there is becoming more and more sketchy as a lot of firms are now not reporting their deals for various competitive reasons. So the data typically comes from press releases and our public filings. And if it's not one of those two methods, then it's not going to show up on this number or this list we're using to counts. They would be careful there. I think the general feeling we get around the office, as Harrison mentioned, is things are still trucking along, no real change year over year. But if you look at the pure numbers, through the third quarter, we were at 320 in deals versus 439 last year. So I don't even know that that's right. So I think it's more of just a feel of how the market's performing and just looking around and talking to folks. It's going to be more important going forward than looking at some of the data that's being published on the actual number of
And there's
transactions.
some, Webb, the names and logos. There's some that have been in this game for a really long time. I've been in the industry 10 years, right? And so there's some that have been there consistent throughout. And there's others that have faded away and new folks that are coming in, but there's still 50 plus active buyers in our industry that exist and new ones that are being formed every day and equipped differently with technology. And so I think we kind of have a reshuffling of the deck, if you will, in terms of the buyer landscape, but it's as healthy as it's ever been from where we sit and see in the US and kind of North America.
Okay. And Brian, let's go to you. What about just kind of the broader economy this year, impact on our industry, things that you saw play out? Any thoughts there?
Yeah, I mean, I think the economy to date's kind of been a mixed bag, is how I would describe it. I mean, the broader market has performed pretty well. If you look at the S&P 500, it's up roughly 10% for the year. GDP is positive. Employment is kind of a mixed signal. there's a lot of talk about the Magnificent Seven and how their performance is driving a lot of the actual economic or equity growth. There's talk of an AI bubble that is building and it's taking place. Who knows if that's true? I think one of the most interesting stats I saw recently is that if you look at the household debt numbers, they're trending up in a pretty significant manner, meaning that inflation is still having an impact on folks. And as a result, they're buying. I saw retail sales are expected to be roughly 4% in November, December. So it looks like people are buying, continuing to buy. The consumer drives a lot of our economy, but it looks like they're taking on debt to do that, which is not, as we all know, sustainable unless you're our government. So, I think that the jury on the broader economy is a mixed bag, and people are still kind of holding their breath. I think what's been most interesting to see is how the market how they've dealt with or thought about the decreasing organic growth for the public brokers. Their organic growth has been roughly 5% for the last few quarters. And we really hadn't seen that show up in the public markets through the third quarter. I pulled some numbers through Friday. And if you look at the 5 established public brokers, on average, they're trading at about 14 times EBITDA now. Which is a material decrease from where they have been. I mean, in the first quarter, they were at 19. In the third quarter, they were at 16 roughly, and now they're down to 14. So the market's taken a pretty aggressive view of the reduction in both existing organic growth and projected. I think that's probably a short-term phenomenon, and they'll bounce back. But certainly the short-term reaction has been pretty dramatic for the public brokers.
Great. Good data. Thank you. Before we turn our focus to next year, let me ask you each a personal question here. Think of a project you did this year with a client, a story that comes to mind of maybe a meaningful event, and maybe a meaningful event that aligns with trends that we're seeing in the industry, things that we know a lot of brokers are grappling with or trying to solve for. Before we move on to next year, maybe share a moment this year that was meaningful. Harrison?
Sure, happy to, Webb. So I think one thing we talked about with the economy, right, is we didn't really hit too much on because there's uncertainty out there is interest rates, right? Are they going up or are they going down? And you hear mixed signals heading into 26, right? So I had a client this past year who owned 50% of his business, and the other 50% was owned by a non-active family member of the business. Good sized firm, right? I mean, pushing 20 million of revenue. So, that's a $100 million valuation of that company in the marketplace, right? Of 5 times revenue with good operating margins, not an insignificant check to write. And that principal said, there's a lot of things that I want to do in this business to unlock growth. And it requires that I have control of the business and to be able to make the decisions in terms of spreading potential equity to producers, right? Hiring more folks, starting new divisions, launching a high net worth personal lines division as an example, or launching a benefits division. And so to do that, the owner found himself at odds a little bit with a family member because, not in the business every single day. And so we were able to help him essentially buy out that 50% partner completely using debt. And we looked at traditional bank sources of financing, carriers, and ultimately this individual or the carrier was the right move for them. And it was kind of a win-win for all parties. And so as we think about the marketplace, and now that owner has 100% control of his business and can spread equity and bring others along how he wants, and super excited for him and the growth trajectory of that business. This is what we see typically, when someone is able to kind of unlock control of the business and put the processes in place. A lot of what we talk about on the Red Zone, you see that exponential kind of growth following those initiatives, and it lags, a year or two to have those initiatives go in place. So I say that in the sense of what do I think about for 26? If we do see a rate drop, I think more firms are looking at using debt capital as a strategy. Hey, history repeats itself, right? How do we learn from super low interest rates that were there during COVID and strategies firms took? And so firms might want to think about leveraging debt to basically clean up their capital structures. If you're a big believer in where the business is going to be over the next 5 to 10 to 15 years, it might make sense to pay a little bit more today to unlock that future growth. So that would be my story this year, just seeing and it's not an insignificant bet either. I mean, you're going to the bank and borrowing a bunch of money, and to see someone bet on their business and bet on themselves, that's a super encouraging trend for my perspective.
Yeah, it'll be fun to watch that firm grow, and I know we're all cheering for him. Brian?
Yeah, mine would be being on the team that completed the Woodruff Sawyer transaction. It was unique in several ways. One, they were a very complex, sophisticated firm. So with that came a lot of work and effort to find them the best solution or best home for them. But probably more importantly, they were good friends before we did the transaction, but became even better friends during the transaction. And that really means a lot. It's probably what I enjoy the most about doing a deal anyway. So that was really cool to see. You know, they were a trend we hear often is, hey, we need somebody that we can partner with to make us better, to take us to the next level. And that's exactly what they were looking for. They were a very strong business, performing well, but, you know, could they keep up the pace and keep pace with some of the larger brokers around them? And they determined they need to find a partner. So that's what they did. And we were lucky enough to be with them a couple of weeks ago. They're in the middle of integration. So, of course, that generally sucks. But by and large, I think they're enjoying and are happy where they are and see a lot of opportunities on the horizon. So be able to be a part of that and help them come up with a great outcome is just a great was really one of the highlights of my
Well,
2025.
yeah, and certainly a landmark deal for the whole industry this year. I mean, Woodruff's reputation and brand been around forever. That was obviously a notable moment for a lot of people. I'll share I'll share two. I'm the host. I'll do whatever I want. I'm going to
Yeah,
share two.
but sure,
Uh,
yeah, take the mic, Webb. Go ahead,
do
buddy.
whatever I want. My first one is similar to Harrison's, a great client of ours that since it was founded probably 50, 60 years ago, always been family owned, only family. And for the first time, expanded equity beyond family members. And we helped them do that to more widely distribute ownership. And we kind of changed their ownership model. And it's already fueled and accelerated their growth. They were already a top quartile organic growth firm, and sharing and spreading around the wealth per se, distributing equity in the way that they did, which is a really smart way to their top performers and to people that they believe are long-term solutions and part of the future. And we've been tracking their growth over the last, 6 to 9 months, and it's been tremendous. So cool to be a part of something like that and help a firm that always did things one way, do things another way. Kidding aside, my second one is brief. It's just I wrote about this in a Reagan View, but just being out at the CIB meeting at the Broadmoor for 4 days, walking around that resort and just the sort of youth movement that exists there. I've been going to that meeting for 18 years, and I feel like in that 18 years, it went from my grandfather's group to my father's group to my peers in a pretty quick period of time. And it's just cool to see the prioritization people put on succession planning and how young emerging leaders are really getting their chance to run these great firms. And it's just fun to see your peers in those roles. And there was a lot of good energy out there. So with
It's great
that,
that it's great that you think you're still youthful. I guess it's in the eyes of the beholder, right? What is it's
yep, younger than you, older than Harrison. So
If
right in the
you look
middle.
at if you look at how he's dressed right now, we can still put him in the youthful category. So good.
we'll just describe youthful from this point going forward as middle aged.
Yeah.
All right. Moving forward to next year, a very specific question for you guys. I want to bring it back to the organic growth piece. Strategies to sustain organic growth. The last 5 years, a lot of firms, most firms have enjoyed a nice run here. Strategies to sustain organic growth. What do we do to combat the slowing growth rate? If you're a $5 million firm, what do you focus on in 2026? If you're a $50 million firm, what do you focus on in 2026? What new growth strategies are out there beyond just, the blocking and tackling of organic growth and sales velocity? What other things can we consider? Harrison, let's go to you first since Mac made fun of my age.
All right. So to start, I would say I'm going to put this in the bucket of relationships and trust. So I think we have been through, if you look at the past 5 years, an insane convergence of events, right? From social inflation to general inflation, the economy to COVID, all like carriers taking significant losses. And so why do I frame that? It feels like a little bit even though the world is crazy, it feels like we're stabilizing in the insurance marketplace a little bit more so than where we've been. And so what I would tell folks, I think, about growth strategies is to focus on those relationships and trust. And what I mean by that is your trading partners. So your carriers, your wholesalers, brokers working together as a distribution channel with a mindset of not I win, you lose, but how can you win and grow with your trading partners? And that can mean giving input and saying hard things when it's hard to hear at a carrier advisory agent panel, right? Coming to the table and as opposed to just asking for more dollars on contingents, bonuses, or overrides, develop a growth plan with those carriers so you can win together in that. Maybe they'd help back some of the initiatives that you're looking to put in place in the organization. And I think at the end of behind each of these organizations is people and there's relationships. And that has not changed despite the influx of technology in our business, the necessity to deliver results. And so I think if firms that are coming to the table and they're acting transactionally, I think that's going to bite them. That might be a short-term win, but I mean, I am feeling just just trading partners on whatever side of the table you sit on, there's a growing resistance to that. And so I would just say thinking about partnerships and not just kind of optimizing 1 year profitability for a long-term strategy. That would be the first piece. And then pair that with if you are a smaller firm, right? Maybe you're a $1 million revenue shop or $5 million revenue shop listening to this, even up to $100 million in revenue, considering potentially combining with firms like from an aggregator perspective on a contingency or revenue basis to help drive more profitability, right? So, and there's more options there that exist today than there ever has been, right? Because there's investments that need to be made in the businesses. And so from an aggregator perspective, do you join in entirety and put all of your business there? There are some that now offer on the table. Maybe it's just select markets that you don't have a ton of volume in that you can't devote the time and the relationships to because there's only so much ability to feed so many mouths. Maybe that makes sense to join on just a specific discrete basis. And so when you're thinking about this strategy, right, like it seems like a strong relationship, you wouldn't have to go the aggregator route. And some firms do go there. But the one thing I would say if you go that route is to read the contract. I think there is more kind of gotchas in some of those aggregator contracts than there ever has been in terms of the industry. There are definitely those that don't, that are very transparent in how they operate their businesses. But the number of brokers we talk to, that brokers are waking up to this to say, like, make sure you're really reading the contract that you're signing, you're understanding what you're signing up for, so you don't encumber the asset value of your business. So balancing the relationships with what's good stewardship of the business and do you do it together. And I think, there's different ways to do that and kind of create a win-win. And so I think firms have to be thinking about that because if growth is slowing, right, to bring it back, there's going to be pressure on profit. And therefore, you have to find ways to sustain those levels of profitability so you can make the growth investments you need. And that might be, partnering with folks to do that. So on a direct basis with carriers or joining others that are helping you get some size and scale as the other billion-dollar brokers in our industry have. So those are two comments that I would throw out. Mac, what about you?
Yeah, I think I would, you mentioned the profitability pressure. I think there's two types of firms that are going to appear when growth slows down, or they're already appearing. That's those that maintain their operational discipline even when they were making a lot of money just via rate increases. And then there's those that kind of lost sight of some of those disciplines just because they were making a lot of money. And as growth slows down, it's going to be like walking in the closet and turning on the lights and watching the cockroaches scatter. Some folks are going to be scattering. So, but for those that have maintained that discipline, they're going to have a great opportunity. And it kind of goes back, we're going to zing when they're zinging. Those firms have a great opportunity to invest because they had that discipline and now have the resources to do that, investing in the downturn. And one way I've seen that be incredibly beneficial, or where some firms have had some great successes, is expanding geographically, and by going into new geographies that are emerging or already hot, and then going in those geographies and finding the best talent they can, hiring them and letting them run. I have several folks that have done that, and it's been really successful. But to do that, you got to have your house in order. One. Two, you got to be willing to put in the effort and take the risk to go into those new geographies and go find those folks. None of that is easy, But I think investing in a downturn, it can have pretty dramatic implications when the market does turn back in a more positive light. Not that it's bad now, but you just a rising tide raises all boats, and if you kind of position yourself to be awesome when the tide's low, you're going to be even better when the tide's high.
Well said. All right, I'm going to start the 2-minute drill here and we'll work to wrap this up, but want to do predictions for next year. We're going to stay right here on this organic growth subject and put you guys on the spot. What will Q4 2025 organic growth be? What will the median be when we get the results of our GPS survey in early February of next year?
7%. That's my number, Webb. 7%. I
Okay.
think we'd see a drop, but not drop significantly. Brian?
Yeah, I mean, I think the math, if you just run through the math and what's going on around us, I don't disagree with 7%. I do think what will be more interesting and probably more noteworthy, but probably won't get the news where the news flashes that it deserves, is that I think profitability is actually going to be up year over year. So even though organic growth is going to be down, profitability is going to be up, which is a pretty good story. And if that's truly the case for firms, or for those firms that it is the case for, they're going to go into 26 with some momentum, and if the market keeps slowing, to be able to keep investing.
Great. All right, I'm gonna let each of you leave us here with one prediction for next year, something you're focusing on. Harrison?
Yeah, so I think you're going to see more firms come to market to switch out their institutional investors. You're going to see a lot of capital raising next year. Firms have been waiting. There's pent-up demand in the market. There's still a lot of investment appetite, and yet there's going to be more scrutiny on those firms. And so I think if the tide goes out, businesses are going to get exposed. And so what I think you're going to see next year is you're going to see, we might sit at 6.5% organic growth, right? A continued decline slightly. But what I think you're going to see is a growing divide of your top quartile, the spread between your top and bottom quartile performers, largely driven by two things. What are those firms doing on an investment in production staff in their sales organization? So I'm leaning in heavily to that right now. And then also on the technology side, driving profitability. There's been a lot of point solutions, but a firm's going to be able to put that together over the coming years. And I think institutional investors are going to be evaluating those firms of size that come to market with those filters in mind. How are you leveraging technology, and how are you investing in your future sales infrastructure, not leaving the organic growth of the organization to chance?
Yeah, so I think that we're going to continue to see some softening in the rate environment. I don't think that's going to change. And given, as we just talked about, we hadn't had really any huge events this year, I think that's just going to reduce rates even more. So I don't know if they're going to go negative across the board, but I think there's going to be continued pressure there. I think what we've got to be prepared for is the broader economy and what that's going to look like. As I mentioned earlier, there's a lot of mixed signals, but what is becoming increasingly clearer and clearer is that the stock market's being propped up by some of the large IT firms, but at the same time, the average American is still having some pretty material struggles with the inflation that exists in the environment. And we could talk all day about what caused that, but that really doesn't matter. It's now how we're going to deal with it. And there's really only two ways to combat inflation, right? There's either you have a material economic downturn, and that does it, or wages rise to make products that have increased in price more affordable. I don't know that we as a country have the patience maybe or to really deal at a fundamental level with either one to deal with the inflation issue. So I think that's going to result in some continued economic struggles as we head into the new year. I think the rate environment might get quicker, or the rate environment from an interest rate might get better, as in lower interest rates. But that, at some level, that's just creating more inflation pressure. So I think the economy is still going to be in for a pretty lumpy or bumpy 2026. I think you combine that with the likelihood that rates will continue decreasing. I mean, I think 26 has some pretty material challenges on the horizon, and we'll know soon what really happens.
And I think with, those challenges exist, whether you're in insurance or you're in manufacturing or you're in, another sales organization, right? So the beauty of our business is It's a recession-resistant industry. So if I'm a principal or an agency owner, there's no better place that I would want to put my capital right now if we're heading into uncertain economic times. That's been proven in 2009. That's been proven through COVID. And so I agree with Mac and everything he just said. And I think that's all the more reason to invest in your business and put capital to work, because where else are you going to put it?
Yeah, and I think that's, we talked about the public brokers earlier. I think that's where they bounce back, is people begin to see, a lot of other industries, the vulnerability they have in economic downturns, and they see the benefits of how this industry wide might have challenges. Growing at 5 to 7% is a pretty good gig.
Well done, guys. Thank you so much for joining us in the Red Zone today. And listeners, thanks for joining us as well. This is our last Red Zone of the year, but we will certainly be back with you in 2026. Have no fear. Hope everyone has a very happy holiday and a happy new year. Take care.